Ways to manage a losing long call. Look at some possibilities for management on a long call position that is moving against us. This question came in from Stephen, and Stephen sent an email earlier in the week. He's currently holding two January 20th, 2023 60 strike calls on Disney. He averaged down a little bit a while back, so the total cost or initial cost was $56.43 per contract. As of today, and he sent this, I believe, on Monday or Tuesday of this week, they're priced at about $35. I'm sorry, it was January 9th. Closing price today was at $39.83. So he gained 10% back from where he was on January 9th, almost to $40, a little bit more, actually, but we're still nowhere near that initial purchase price or the cost basis for Stephen's two long calls at the 60 strike on Disney, expiring in just 7 days. What is the current situation? There's only a few days remaining to expiration. Time is not on the side for this trade, nor is time on the side for some of the management techniques we might use when faced with this situation. Now, the stock is obviously down in price. And so that's why Stephen was writing initially, of course. But the stock is down in price recently. We had a high here of 108 back at the beginning of November. Big decline here, down below to almost $85 per share. Comes back up relatively, still probably at a loss here, and then we do dip down into that $85 range. And since then, we've jumped back up to $100 per share. We've rallied in the last 10 or the last 14 days or so on the position. What is the current profit and loss? What are we staring at here with a position? Again, we have a cost basis of $54.63 per contract. Two contracts, there's $10,926 invested into this trade. Okay, we can get about $40 back, close to it. Let's call it 39. So again, we can get about $7,800. So we're looking at about a $3,000 loss on the position, a little bit more. Now that's intrinsic with the stock at around $99.81, the stock around 100. The 60 strike may keep that $40. That means that Stephen would still be looking at a loss of about $2,900 at expiration in just a few days. So we haven't lost all the value. We're not down 90%, but we're still losing a fair amount of value on that call. What can we do about it? Well, when I got the email, I did answer Stephen a little bit, but I also pointed him to other content that's available so he could look at during the week to make some decisions or concepts that he might be able to use in that scenario. So looking on the playlists on PowerOptions YouTube channel, there's a full playlist on call buying and long calls. And in addition to various videos you might see on managing a profitable long call, search criteria to use, and so forth, we have ideas on managing a losing long call. Can we use the stock repair tool for a bought call that is down, and managing a bought call that is near full loss? Now, we're not quite at those two as well. Well, we are here. I'm sorry. Might be able to take a look at that. But we're not here at near full loss. We're near a full loss on the time premium, but the call is not out of the money, even though it has 7 days to go. Took a little bit of a hit today, slightly, maybe a little bit of a dip, but we've been moving up gradually. So still have intrinsic value, not a lot of intrinsic value in these cases. It's right near the end, right near the full amount of the option price is just the intrinsic value. Now, other things you can do on YouTube, of course, or on Power Options is do a search in the videos for long call. And you've got some ones here, repairing a long lost long call and follow up to repairing a long lost long call. Not the current situation that we're in, but we'll give you ideas on long call management. And of course, if you need to manage other strategies, check out the playlist, as you'll see videos in there for management as well. In these presentations, managing a long call, what is typically discussed? Well, typically discussed is number one, do nothing. The position's down, but if you still have a bullish outlook, you're still holding on to the call because you have time on your side. 90 days, 180 days, maybe 250 days or more, you have time to wait it out to see if the stock recovers from the recent decline, starts to meet your expectation, and could still lead to a profit. Sell a call against the position, creating a calendar spread. I still have 150, 200 days to go. Stock did not do what I wanted in the first 60 days or so. Maybe now I convert it to a calendar spread, start selling calls against it to knock down the cost basis, hoping for the recovery. These two options essentially in this situation are what we might say, or Monty Python might say, are right out. There is not enough time left to do nothing and hope that Disney is going to go back up towards about $120 in the next 7 days. Could it happen? Yes. Could that get him back to break even? Yes. Is it likely? Not really, but we could be surprised. But in any case, that's not really being proactive. That's holding and hoping with only 7 days remaining. Some action is going to need to be done here to try to manage this position. Sell a call against the position. Well, that's normally done, as I mentioned, in a calendar style. We still have several months to go in expiration on the long call that's not working out for us. We're going to sell calls against it to lower the cost basis, maybe every 2 weeks out, maybe every week out, maybe 1 month out. We only have 7 days left, so this would create a direct bull call debit spread, which unlikely would lead to a profit. We'll take a look in the analysis if that's possible, but I have a strong feeling that we're not going to get above the $56 that we want for a call that's above our long call strike price. We know we won't because that's only worth $40 for the same expiration. So that bull call idea isn't going to work. Roll the call down. In this case, we'd not only roll it down, but we'd also have to roll it further out in time to give us more time for the stock to move in our desired direction. Once we do that, we could then sell short-term calls against it to try to help us get back to break even. That is a possibility, but we have to give ourselves more time first. Otherwise, that won't work. Essentially, this is akin to averaging down a long stock position that's moved against you without using options to help protect or help repair the situation. We're going to do the same thing with the option, but we're going to give ourselves more time. What is that going to do? Same thing it would do as to averaging down a long stock position. We're going to put more money into a bad position in the hopes that it's going to recover. But it can be a lucrative management technique if the stock does meet your future expectations going forward, now that the stock has not met your initial expectations for the position. The butterfly or condor repair. Taking your position and converting it to a butterfly position or to sort of an iron condor position, or a true condor position, not an all-call condor, not an iron condor position. That's akin to using our stock repair tool, a ratio call spread against a long stock position to help you get back to break even faster. It can work, but with this, the advantage of having the stock and doing the stock repair is you don't have a set time to expiration on the security. I might be able to find a repair that's 3 or 4 months out in time that gets me back to break even with only needing to see a 4, 5, or 6% movement in the stock instead of the 10% movement I might need to get back to break even. It helps you get back to break even faster. But again, this call has an expiration date and it's coming up in 7 days. So that condor or butterfly spread ratio stock repair against it is probably not going to work. It seems that any of these repairs that are going to work are going to involve number 3 first, where we're going to have to roll the call down potentially, or definitely roll it further out in time to give us more time to do proper adjustments if we want to try to repair this position. Lastly, maybe number 5 is close and convert to the opposite. Well, that would work in the potential scenario that we still had time on the side as well. With only 7 days left, if he takes the loss on the current long call and just buys a put option to do the opposite, now betting on a large movement in the next 7 days to the downside. Probably not a good idea to do. Again, it'd have to be further out in time, but in the email, Stephen mentioned that that's not really his expectation. He expects the stock to stabilize and move up. And we even saw that in the following 4 days after he sent the email, to where the position is now at less of a loss, but we're still not near full profitability, or profitability, I should say, in that case at all. Now, all that being said, since the end price was not known, I want to take a look here on power options to analyze what is possible. That's funny, that slide didn't come all the way through. I apologize for that. There we go. We want to look at steps to evaluate the position. Do any of the repairs that are available fit the expectations, or any kind of reasonable target to get back to break even? Now that we know the end price and the closing price of the position for the presentation, because the stock could have fluctuated wildly one direction or the other as we were going through the remaining 4 days to expiration. So let's navigate now over to our Power Options suite of tools. And let's see, here we go. We're just going to take a look mainly at the portfolio tool and see what ideas are possible with our 5 or 6 different potential repair positions that we mentioned, knowing that 3 or 4 of them aren't going to be useful at all. So we navigate to the portfolio, and here we see our Disney position. 20 of January, 60 strike calls, 2 of them purchased at $54.63 average cost. Current price $39.33 at midpoint at the close, so a little bit different than what I had there. So we have a $7,865 market value. We're looking a loss at $3,061, or 28% on this call, heading into the final few days of expiration. Now, because this is too close, I don't think we're going to see any opportunities, but we're going to give it a go, see if we can find a. Whenever I'm tracking any position in the Power Options portfolio tools, we're going to use the Edit More Information button next to the position and link to Position Actions and then Position Analysis. Whether it's a covered call, whether it's a naked put position, whether it's a spread position. This is going to give us a breakdown of our current liquidation value, future expiration values. We saw time value remaining in price and the current profit and loss chart on the position. If any rollout opportunities were available, they would appear here. We'd have the math done for you to show you potential positions to maybe convert it to a calendar spread, maybe to roll the call down in price or do some other adjustments. In this case, we're too close to expiration, so the repairs that might be calculated for a losing long call, possibly even a winning long call with only 7 days to go, aren't coming up. That's no problem. What we'll do in this situation is walk through some of our manual adjustments against the position, as I mentioned, and we'll just link to the profit and loss chart to do our manual analysis. We could have also linked to the profit and loss chart from that More Information button that I mentioned as well. So here we are with our position. There's the profit and loss. We know where the stock price is. We know what our current loss is on the position. 7 days to go to expiration, not a lot of time. So management number 1, do nothing. Is that viable at this time? Only if you think the stock's going to stagnate, and at one point maybe you saw a 40 or 50% loss on this call, but now you're comfortable with just taking near a 28 or 25% loss just to be out of it. Well, if that's the case, you would just sell to close it right now and move on from the position. That's not really something that's going to help us manage this. Number 2, we talked about selling a call against our long call to try to knock down the cost basis, get us to a better break-even point on the trade, or potentially see a profit if there's a slight movement upwards. But we're 7 days to expiration. We can't convert this to a calendar format. This would have to be done as a vertical spread, and unfortunately, in these scenarios, we know we're too close to expiration. We need a call that's at least the cost basis of our position, $54.63. Those are only going to be deeper in the money, which won't give us the graph that we want. We'll take a look at those in a moment. But even going up here to some of these debit spreads, I need to make up a fair amount of profit. So if I sold the 80 calls that are in the money for about $19.50 and I get 20 points back, I don't think that's going to cover the time value loss we have on this position of about $24. I know it's not, but let's just take a look. We're going to sell 2. Now remember, this is a bull call debit spread, so you might get the $20 back plus the premium taken in, but that's not going to counter the initial price. You're still going to be looking at a max loss of $3,041. Why? Because we're still so close to expiration that both the 60 call and the 80 call are trading right around intrinsic value. This isn't the cost, remember, of the 60 call. That was the cost we paid. If we sold it right now, that value is around $39.43, $39.33. Exactly an intrinsic, actually a little bit below it at midpoint. Stock's at $99.40. Premium for this 80 call is $19.43. That's just intrinsic. We're not getting any time. We're locking ourselves into that loss of $3,000. That's not going to cut it. It's not going to work. All of these examples of trying to do a repair are going to hinge first on doing what? Rolling the call, possibly down in price. Might not have to roll down in price, though, since we are still deep in the money. But we're definitely going to have to roll further out in time, which means what? We're going to be adding to the time value of the cost basis of this position. Once we sell to close this call and roll it out, we're going to lock in the loss that we have on this long call and add an additional cost of time value to increase the time. So our cost basis into the position is going to be much higher than that initial 10,926. But looking at it right now, that's the only way that this could potentially be done as a repair. We are going to take a look at a butterfly and condor without rolling the call further out in time. But first things first, we need to give more time on our side. One thing I want to consider on this as well is what is coming up here in the near term. Let's go ahead and look at the stock research tool from the edit more information buttons on Disney. And we've got earnings coming out on February 8th. Okay, well, that makes sense. I was going to roll out way further beyond that anyway to give myself more time. But if the earnings were out to, say, the end of March or beginning of April, I'd want to make sure I roll beyond that to try to get beyond a potential catalyst that could cause the stock to move in my direction, such as an earnings date, or if there's any news coming up. We've seen a lot of news on Disney recently with a changeover in leadership back to Ron Iger. So that's aside from the point. We're looking at the underlying, maybe even economic dates coming forward, things related to the CPI releases, Fed rate interest hikes, that is announcement states, how they might move the market. That's something we have to consider as well. But we've got to do step one first. We got to sell that January call, sell to close the call that we bought. We know we're going to lock in a loss of about $15, $16 per share on the position. Why is that important? Because we have to factor that in to the cost basis of our position. Yeah, it's about $15.30. It looks like here times 2 would be $3,061. We're locking in essentially that loss right now. That is going to affect the cost basis in that position. Now we have to roll further out in time. And I'm going to show you what happens when we do this here. The custom spread tool, the profit and loss chart, is not actually simulating that I'm closing this call. It's actually going to read it as I'm doing 3 options trades, that I bought a January 60 call, I sold a January 60 call, and I'm buying a further out April, May, or June call. That's not what we're doing. We're going to factor in this loss. We're just going to call it $15.30. But let's keep the same strike. I at least want 90 days. Probably would want to go 154, but let's keep it in April. And let's keep the 60 strike call at 39, 74, 40, 80. That's not too bad, actually. That's only $1 or so above intrinsic value at this point because we're still so deep in the money. 33% in the money from where the current stock price is. So this is mostly intrinsic. Well, let's take a look. As we know, I mentioned the cost basis would go up to $11,116. We pay $8,055 for these new calls at 40, 28, 40, 30, somewhere around that range, plus the loss of that $3,060. That's why our cost basis moves up to $11,116. It's not too bad. I mean, we only increased it by about $200, $300. But we still have to keep in mind our break even still at around 115, 114.85 in this case. Stock price is at 99.40. We are increasing the cost basis with the potential for loss. Now, this profit and loss chart looks smooth, doesn't it? It doesn't look like you'd normally expect to see for just buying a call position. Why? Again, as I mentioned, although this is a useful tool for evaluating rollout opportunities in any strategy, simulating doing the opposite to the leg you want to roll, and then putting in the new option adjustment in this case, you're in a scenario here where it's reading it as 3 legs, and it's evaluating a profit and loss chart at the shorter term expiration. Let's clear that out. Let's put this at a cost of 40.30. And let's add now 15.30 to our cost basis to account for the loss we took on the initial position. So this would be a cost basis now of 55.60. Buying 2 April 60 calls. Cost basis about what we saw, 11,120. That's where we are right now. Increase the cost basis slightly because we stayed so deep in the money where there's only a slight amount of extrinsic value. Most of that cost of the new option is intrinsic value, and we're factoring in the $3,000 loss we took into account from the original position. So, now what? Now we can maybe look at some of the other alternatives. The stock's at 99.40. We have a new cost basis of 55.60, and I'm only using 98 days out in time. What we could consider now at this point is looking shorter term, maybe at least 14 to 20 days out in time. Let's just go to February 3rd. Give ourselves some upside room. More than that, I want at least $1, but let's use the 105 call. It's about 92, 93 cents. That is not a lot when considering we have a cost basis of 55.60. And it doesn't get us back up to break even. It does reduce the cost basis down for the next 21 days to the price we initially had. New maximum loss of 1,800. Best case scenario is a loss, I should say, of 1,800. Maximum loss is still around 10,936. And just like a covered call, if the stock starts to move up to 105, we'd look to manage the position going forward. One of the advantages of using the February 3rd, I did select that for a particular reason. And the particular reason, of course, is that as we just looked a moment ago on the stock research tool, it is confirmed that the earnings is coming out on February 8th, 2023. That's what the CONF there means. It's confirmed across the exchanges. Why is that important? Well, we're going to see market flux and we're going to see market movement between now and February 3rd, 21 days away, absolutely. But we're not crossing that catalyst between now and the sold call expiration where the stock might suddenly jump up to 120 or 130 and we're caught with a capped gain. We could be caught with a capped gain if that happened non-related to the earnings, but we're not doing it around the earnings cycle in this case. This is not going to get us back to break even though, and we can see that. How do I know that? And what do I mean? We still have a cost basis of 10,936. We're roughly, let's just call it 40 points in the money. So we're still down $2,000. I'm only getting $200 best, selling premium 92 cents for 2 contracts every 21 days. I only have 4 right cycles between now and the April expiration. 4.5, let's call it. So that means I'm only collecting $8 or $9 in premium against the position. Is that going to get me back to break even? Possibly, depending on where the stock is and what the stock does. It could, that premium, lowering the cost basis, of course, let's say we get 8.5 in premium. So This right cycle, we get $200, excuse me. Then the next right cycle, which would put us at the halfway point, we get another $2. Then 21 days later, we get another $2. And sort of that last 16 or 17 days, we get another $100. So be at $900 off that cost basis. Let's just call it 900. I think it would be 8, but let's call it 900. So where's that going to put us? Well, that's now going to put us at a cost basis of $46.60 on the position. So as we got closer to April expiration, the stock hasn't reached above whatever call strike price we sold. We didn't have to do much management. What does that leave me with in this case? That leaves me with a break even of 106.60. I'd need the stock to be there at April expiration. That's taking a lot of things under assumption that may or may not come to pass. No management on those short calls, still able to get 90 cents to $1 each 21 days. We write the position. You know, there's no guarantee of that happening, but that's a possibility. But how is that possible at all? First, we had to move further out in time to give us the time to move a position. Ray had commented, couldn't you get a better break even by purchasing a lower price call out to April? Absolutely. But what we don't know and what we'd have to look back and analyze the time frames that Stephen entered this trade, Ray, he bought a 60 call. The date that he initially entered that trade matched some criteria set he was using of how many days he wanted to give himself, whether it was 90, 100, 120, 200 days out in time, likely a range in the money or likely a range of a specific delta he wanted based on his bullish outlook for the stock. So now with the stock at 99.40, now that it's recovered, we're a good 33% in the money with a high delta for 90 days out in time, sort of maybe what one might call a stock replacement position. But as you mentioned, we had that higher break even with that other price, including the 15.30 loss. Let's go cheaper. Let's take a look at what Ray was suggesting. We'll stick in April just for a fair comparison against what we saw. And rather than the 60 call, let's go to the 80 call. Premium of about $21.65, $21.60 at midpoint. We're going to buy 2. Remember, the break even on the original position was 114.87. Sorry, I got rid of that. Okay, well now my break even's only 101. That looks fantastic, doesn't it? Compared to the 114. But remember, let's call it 21.60. I'm not paying 21.60 for this call. I'm paying 21.60 for this call. Got to factor in the 15.30 from the loss we took on the original. So I'm really looking at a cost basis of $36.90. Hey, that's only $7,380 in the position, taking into account the loss we had on the initial long call. Break even, though, is higher because we're 20 points higher on the strike price. This option has more extrinsic value due to the at-the-money bell curve. Our stock's here roughly at 100, and the at-the-money bell curve, kind of goes like this. And what it tells us is the options that are deeper in the money have lower time premium. So this might be the 60 strike. And here might be the 80. Disney's a little bit less curvature than this, as we saw. It's only about $1.50, I think, in time value that we saw compared to a very small 20 cent or 30 cent time premium here at the 60. And of course, we have the 90 here, and here's the 100. And on the other end, here's our 140 on the out of the money range, and so on and so forth. So the risk and the break even are slightly higher because we're paying more extrinsic value into this position, and we're taking into account the loss we took on the initial trade. So again, you can get a lower cost rate. That in this scenario doesn't exactly equate to a lower break even, unfortunately, because of the extra time value where that 60 call was almost all intrinsic value. Even out to April, there's only a small amount of extrinsic value. So let's go back again to our April 80 call with that. Oops, I'm sorry. Just have to change it. I know you're not seeing anything. I want to see if I could just pull that back up there. The April 80 call with that rough cost basis of 2160 and 1530, 3690. Here we go. Okay, so that's where we are. The cost base, nope, that's not right. I apologize. Not the 80, I meant the 60. See, I still did it wrong, even though I paused the screen for you guys. I apologize. Let's go to the 60 call once more and add in, there we go, that's better. We're going to call it 4030 and add in our 1530, so 5560. That's what I needed. There we go. And break even, I'm sorry, 115.60. The 114 we saw, Raven, I'm sorry, that was after we sold the call near term. All right. So we have to increase the time in order to do the repair, Stephen. That's obvious step one. What about this ratio repair I mentioned, this butterfly or condor position? Well, one of the signature tools we have on Power Options is the stock repair tool. It helps you build a ratio call spread that might help you get back to break even based on the current price of the stock. This is not a stock. This is a call option that has a set expiration date and an inclusive price. If I were to exercise my call today, after I make this rollout to April, what do I essentially have? I own shares of stock at 60 with the included cost basis from the other roll and the purchase price of 55.60, which means my total investment into the position would be 115.60. So we can take a look there. Let's do it from this view. I could go in and just type DIS, cost per share, 115.60, which would be the break-even price at expiration for this call, and we have 200 shares. Unfortunately, we're not seeing any repairs that can be built except out to June expiration. But that's not something I can do. This is a ratio call spread. We're going to sell 2 calls and buy a lower strike call. That's the stock repair ratio call spread. It helps you get back to break even faster because of the advantage of the bullish position. I'm sorry, the bull call debit spread nested in that trade. Let's just take a quick look without going too much in depth into the stock repair position. I own 200 shares of stock at 115.60. The tool showed me that I could buy a June 95 call 2 for 12.50 and sell twice as many at the 105 strike for $7, taking in $14. So I'm getting a positive net credit of $1.50. I'm able to sell twice as many calls as I'm buying because my broker would see this simply as a covered call, 200 shares that I own already and 2 sold calls, with a bull call debit spread at the 95 to 105 strike, 2 contracts each. I lower the cost basis down on the position slightly. Now the cost basis would be $23,000 because we're assuming exercise of that call at 60 with our cost basis. So we're at 115.60. That's why it's much more than the long call. I don't even think Stephen wants to do it, but that's not what we're trying to analyze here. We're trying to analyze is a stock repair available. And out to June it is. I'd only need the stock to be trading at 104.55, not my cost basis of 115.60, due to the benefit of this accelerated growth here as I'm gaining positive delta back on the stock and the benefit of that extra 10 points of my 95, 105 bull call debit spread. But this is a June series. If my call was out to June with the prices I have, this would look very similar as a potential repair to June expiration, where I'd only need the stock to be trading at 104.55. We don't have a June call. We have an April call in our examples, in our management. I don't want to sell those calls beyond that point because that's going to require a lot of extra margin because my short calls out to June are only covered really till April with this 60 strike call. But that's okay. I've got 2 debit spreads going on. Would an April repair work using the same strikes? Probably not, or it would have appeared in the position. What was the rollout? Buying a 95, selling 2 or 4, 105s. All right, because these were 2 contracts apiece. So that's one thing I forgot to do on the first adjustment. That's okay. We were looking at the numbers, not really the analysis there. So we have 2 contracts at 55.60 after our roll. We're going to buy another 2 contracts at 95. And we're going to sell 2 more at 105, 4 more at 105. Does it get us back to break even? Closer, but you're not over that threshold yet. Does give you that benefit of the bull call debit spread. You have 2 bull call debit spreads, one at 60 and 105, one at 95 and 105. 2 contracts apiece. But again, cost basis is still up above where we initially started. This one is done at a debit, as you can see. We didn't get this one at a credit. I normally only want to do a ratio spread for a credit. But what is this? This isn't a butterfly. You're absolutely right, it's not a butterfly. This is a ratio repair that usually converts to a butterfly depending on where the loss is that initial long call. A true butterfly repair, we're going to go somewhere halfway between where the stock is now and the strike prices, sort of as we looked at before. We have the 60, the stock's at 100. Let me try to sell 480 strike calls and then buy 2 100s. Oh, that didn't click. I'm sorry. We already own the 60, so we're going to sell twice as many in the mid, buy out in this far range here at 100. Is that going to get us back to break even? I don't think so, but it might lower the loss, but this is all the way out until April expiration. Oh, 1.2% or $95, break even price of $80.47. But we're already here with the problem at full loss. That's not going to do it. We probably want to sell right at the money and buy further out of the money to try to look at a potential butterfly repair on this position. I don't think that should give us enough money, maybe with the bull call debit spread side. So now we're going to sell 4 100s, buy 2 140s. We're only going to get $14 back in premium from this. And that might be okay. Well, that's yeah. So we're going to take in $2,830 for 4 contracts and take 34 cents, $34 away from that. We lower our cost basis down to $83.24, but we're guaranteed a loss if the stock's at 100 at April expiration, and that's the best outcome. If the stock is below that, we still have a loss. If it's above that, we're in the loss zone, and you could lose as much as $8,000, of course, on either side, upper and lower break-evens, as opposed to just the lower break-even with the call that we're in. So if the butterfly repair doesn't work, the condor repair is probably not going to work. They all call it condor because you're going to be receiving less premium up front to begin with, and the strikes are going to be more shallow on the bull call debit side, but also the bear call side. So in that case, it's not going to be a reasonable repair. And then, of course, closing and converting to the opposite might not work as well. As you'd have to factor in this cost into the long call cost even, which is what I mentioned. Okay, so what have we really learned here? Have we really learned anything? Well, looking again at the management review, doing nothing right now, only 7 days out, is a moot point, unless you've decided to take the loss on the position, accept it, and move on. Settling a call against the position as it stands right now is a moot point. Don't have enough time. Rolling the call down. Oh, sorry about that, folks. Rolling the call down and must be further out in time is the only way that I could consider this scenario or maybe this scenario, but we saw that didn't even work too well. But maybe over time we could get to a break even with this. The butterfly didn't really seem to work as it was. The butterfly didn't seem to work with rolling down right now based on prices. The condor wouldn't work if the butterfly didn't work. The butterfly gives you the most oomph because you're selling twice as many at the money. Whereas with the all call condor, you'd be selling out of the money calls and buying a further wing and selling a slightly in the money call against your bull call debit spread. So you'd be getting less of that peak premium. It'd be more shallow, be a little bit lower in a flat table across a wider profit and loss range perhaps, but you'd still be locking yourself into a loss. Close and convert to the opposite. I'm not spending too much time on that because that wasn't Steven's sentiment. But it's looked the same thing as a long call. We'd just be buying a put that now has an increased cost basis, factoring the loss we took from rolling the call down and out. Yeah, there is a sixth one I should have mentioned. It's usually the first one that's mentioned, and that's close and just be done with it. The other one is do nothing and wait, but close and just be done with it, take the loss, look back to make it. But that wasn't Steven's idea. He's still bullish a little bit long term. He thinks Disney's going to recover. We know earnings are coming out February 8th. Rolling the call out in time is a necessity. You'd want to analyze if you wanted to roll it down further to stay within the deeper delta range if that's what you were looking for on the position. If you had a deeper delta in your trading plan, Stephen, when you originally opened it. As Ray mentioned, you could also roll it up for a cheaper price, but that doesn't equate necessarily to a better break even, depending on how much extrinsic or time value you have to pay for the option that is less in the money. All of that is based on, at this point, having opportunities to do any of the other management techniques that I can think of off the top of my head and from what I looked at a little bit during the trading week, Stephen, since you sent your email on January 9th, is all obviously focused on step one first. Look to roll the call really out. Out at the same strike, maybe out at a higher strike price. See what your new break even is, what your risk reward is, and then you can start to analyze other potential adjustments after this is handled. Otherwise, right now you have the choice to do nothing, hope that the stock continues to move up and you have a little bit less of a loss in 7 days on the 20th expiration of January, or close now, take the loss, and move on to find something else. So I hope that helps out, Stephen. I hope that reviews some of the other discussions that we've had, how to use the Power Options tools to evaluate that graphically. Anyone has another idea here? Oh, okay, Donald, this wouldn't be a good situation to use because you're locking the loss. Sorry, we'll go back and look at that in a second. This is why I didn't show it, Donald, because it's not something I would do. You can all tell by the recent videos, recent discussions we've had that I prefer, of course, and Ernie prefers as well, to use the married put approach for controlling risk on our positions and applying the 12 different income methods as discussed in the blueprint, the full course, all electronic course on the married put approach and the 12 to 13 different income methods. Don's comment was, I lost the number. Why not take assignment on this position? Could you take assignment on our current January 60 call? Oh, I did want to go there. Let's go back. I'm sorry, portfolios. And convert it to a married put position. The reason why I wouldn't do this, Ron, I'm sorry. I see the chat screen. You don't see the chat screen. I've seen your questions. I'm going to get to those in a minute, but this was the topic that we were going to cover first before we got into the live questions. I'm answering Don's now, Ron, because it's related to this particular topic. We're going to talk about your spread positions in just one moment. In any case, here's the call. If I take assignment on this, what do I have? 200 shares of Disney at 114 that's trading at 99.40. That would be my outcome if I did nothing and just allowed my broker to exercise. I'm not assigned. I'm exercising my calls because I told him not to do that. And we'd have the cost basis of 114.63 or that 22,800. Whoops. Oh, I'm sorry. Okay. Let me do it this way. Sorry about that. Completely forgot. Okay, let me go at just 144 days. Okay, there we go. And I'm going to put this at a buy cost of 0. No, I'm going to put this at a buy cost of 14.63 and sell this for 0.001. Now, what am I simulating here? I'm simulating a cost basis, a synthetic long stock position, Don. What our Disney position would look like, a cost basis of 114.62, buying a 100 call for 14.63, selling a 100 put for 1 cent. So that's roughly what the cost would be if we were assigned the shares of stock. I just did one contract here, but it would be two. So our cost basis would be, up this price is to 22,000 for the stock itself. Let's just do that. Okay. So I'm sorry, I forgot that I couldn't do it that way. First, I wanted to show you just what the long stock would be. We're locking in a loss of $14 already, Don. And could I convert it then to a married put position to control risk further? Yes, but we'd want to go slightly in the money. With Disney, probably the 110 would be perfectly fine. I could probably get away with the 105 and still have that controlled risk that I want. But in this case, we'd have a risk of 3,719 as the maximum risk on the position. As a leveraged synthetic married put, it'd be a percentage loss of what we had invested of 65%. Now let's put the stock back in. 200 at 114.62. And we're taking a risk of 14.5%, Don, factoring in the locked-in loss of the original call roll position, and then allowing exercise, just leaving it alone, remaining in the money, exercising the stock position to buy shares of stock with our cost basis of 114. Now we've got a break-even of 128.60 with a maximum risk of 14.5%. Can be managed with the 12 different income methods, Don. Absolutely. Can't lose more than 3,700. A little bit more than where we are right now if we just close the long call position monetarily. Gave ourselves more time, 154 days, to continue to manipulate and adjust the position to get back to break even following the rules in the blueprint. But I don't know if I would do this simply because the risk is in double digits, Don, and is beyond my expectations and what I look for with that structure, as you know.